able to wrap up this section with this podcast, so let's conclude this toolbox part. Finally, the approach remains sensitive in terms of integrated assessments to estimate impact of climate change on GDPs and aggregate economic indicators, either sector-wise or aggregate, as we say. The approach remains sensitive to the specification, which explains why different analyses have led to different results. Whether studies assume that climate change will affect GDP levels, so temporary shocks, or GDP growth, which could be permanent shocks that will accumulate over time, is particularly important. Burke et al., for example, assume that the effect of climate change on GDP is permanent and cumulative, affecting growth rates and not GDP levels, which largely explains the large magnitude of the impact they project for the end of the century. What do you do with that kind of information going out to 2100? What kind of decisions are even practically possible, considering the uncertainties in them, sometimes which remain unspecified, unquantified? Overall, using empirical analysis to assess climate change impacts beyond the next few decades, when changes are no longer expected to be marginal, should be done with great care. Just to add a point here, even with the Earth system model projections for the future, RCPs are developed by IAMs and then used to simulate future pathways, climate projections with Earth system models. But the first couple of decades, the projections are dominated by models and their uncertainties, but beyond that, scenario uncertainties begin to dominate, where the temperatures will go, extreme events will go, sea level rise will go, and so on and so forth. So then you are translating that uncertainty to estimate on GDP impacts. Obviously, we have really gone into la-la land sometimes with these ideas. Okay, so let's look at briefly another taking action, sample targets and indicators. Am I here sitting in non-display mode? Okay, that's my bad. Taking action, sample targets and indicators. Regulations of banks, insurers and large investors include specific disaster and climate risk requirements. All banks, insurers and large investors conduct stress tests for climate and disaster risks, including at least 2 climate scenarios. So we looked at RCP 4.5 and 8.5 as examples. All banks, insurers and large investors provide a quantified estimate of their exposure to natural hazards. This is becoming now more and more of a regulation, especially in Europe. US is trying to bring it along as well. When the rest of the world will catch up, and if they will catch up, and what it will mean in terms of banking practices is not yet very clear, because sometimes lending facilities can let people or allow people or even incentivize people to take risks that are simply not wise, right? Climate change and natural disasters can impact the financial sector balance sheets through 4 overlapping channels. Operational risk, this includes damages to the financial structure, branches and office buildings. Market and liquidity risk, reassessing financial projections and risk premiums will impact asset valuations. This could trigger pro-cyclical materialization of losses and tighter funding and liquidity conditions, particularly when it's due to a disaster. Droughts and other natural disasters can also drive up commodity and energy prices, which is very clearly playing out because of the Russian invasion of Ukraine. Gas prices, coal coming back in some places that never dreamt of burning coal. US and Norway making money by supplying gas to fill the gaps that was created by loss of gas supply from Russia, and so on. Credit risk, damage to infrastructure, higher prices, lower productivity, and so on can adversely affect borrower repayment capacity. Lower collateral prices amplify credit risk, particularly when uninsured. In natural disaster-prone economies, sovereign credit risk could adversely interact with financial sector risks. Okay. Finally, underwriting risk. Physical risks can impede the pricing accuracy of insurance and reinsurance liabilities. This can cause losses to insurers, raise premiums, or even render some activities or geographies uninsurable, raising fiscal costs as governments are forced to backstop losses. Lower availability of insurance can have important repercussions on investments and loans. Coming closer to the end, one of the last toolboxes, Toolbox J, stress testing financial institutions for disasters and climate risks. I have maybe three podcasts on this topic with more recent literature from the Network for Greening the Finance System and US Federal Reserves and so on. Okay, stress testing is common in financial sector. In practice, it's possible to estimate the effect of some negative but plausible socioeconomic scenarios. For example, a 3% drop in GDP on individual financial firms' portfolios or across the sector, providing insights on vulnerability in the firm or sector. Some regulations mandate that financial firms demonstrate their ability to weather an economic crisis or shock through such a stress test. If you look at the financial crisis of 2008 and then before that, I think 1987 maybe, you know that the stress testing is not as great as you would think. Stress testing is now also used to investigate climate change related risks, though this is mostly for so-called transition risks, which are those associated with policies enacted to reduce greenhouse gas emissions. So IPCC Paris Agreement brings along policies, nationally determined contributions, and efforts to reduce greenhouse gas emissions, which are transitions, and they bring some specific risks with sunset industries, sunrise industries, and so on, and that financial institutions have to worry about. For example, Battiston et al. Link global macroeconomic scenarios to major commercial banks' portfolios to estimate their exposure to rapid decarbonization. God forbid we become suddenly very good technically at taking out carbon dioxide from the atmosphere and hiding it somewhere, or everybody becomes carbon neutral or reduce their carbon emissions tremendously from shoes to iPhones to cars, then how does that affect commercial banks? Stress testing the financial system to the physical risks of climate change, however, is more challenging because the impacts of climate change are more spatially heterogeneous than the impacts of climate policies. Estimating a company's vulnerability would require considering the localization of every production unit, because the global warming is all local, climate change impacts are local. But this information is not enough, as a well-designed asset in a high-risk area can be very resilient. And information on how assets are designed, for example, whether a factory can cope with heavy rain, is simply not available even to companies themselves. A firm's or sector's vulnerability also depends on its suppliers, clients, and the transport and communication networks that their relationships depend on. And while firms usually know their direct suppliers, only the biggest ones have the resources and capacity to understand their full supply chain and its vulnerability. So Apple says it's going to worry about not just its own process of reducing carbon emissions and going net zero, but also its a complete supply chain and transportation chain. So iPhone is produced in components, assembled, and sent off. So it's going to worry about the so-called Scope 1, Scope 2, Scope 3 emissions as well. Okay. Finally, uncertainty around future impacts is so large that any single scenario is unlikely to capture a firm's or a sector's full vulnerability to climate change. This is obvious. In this context, governments and financial system regulators have two complementary options. Top-down stress tests. This is what is being done under NGFS and Federal Reserves in the US. First-order assessments based on sector-level vulnerability to climate change. For example, vulnerability of Uganda's coffee production, assuming that all firms within a sector have a similar vulnerability. Big assumption, but nonetheless. This approach provides insight on an economy's vulnerability based on its sectoral structure, disregarding heterogeneity across firms and individual firms' ability to adjust to a shock by diversifying to other activities or developing new technologies. That would go to resilience in that sense. Bottom-up stress tests. Firms and financial sectors conduct their own risk assessments based on their in-depth knowledge of their production systems and supply chains, and publicly available data on climate change and natural hazards, building knowledge from the bottom up that can be aggregated over time. Okay, those are the two approaches. A firm's or a sector's vulnerability to climate change will depend on its ability to respond to anticipated and non-anticipated impacts of climate change. Top-down and bottom-up stress tests should therefore go beyond the direct physical impacts to assess various firms' and financial actors' ability to absorb shocks and adapt to climate change. For example, a firm that's heavily exposed to major hazards but has well-developed contingency plans and is well insured may be less at risk than a firm that's less exposed but not prepared in this sense. A European Bank of Reconstruction and Development and Global Center for Adaptation report recommends that all firms and private actors assess how climate risks may affect their value chains and operations and put in place the appropriate risk management systems. So we will look at this figure here for that. How climate change affects corporate value chains. Okay, this is from 2018. So you have adaptive capacity depending on quality of management as well, so they are closely related. Impact on corporate performance and impact on credit risk. So you have feedbacks here from the bottom up, first order impacts into supply chains and adaptive capacity affecting supply chains, also affecting operations from both sides and markets from both sides. What are here? First order impacts, acute and chronic climate hazards that directly affect corporate operations, supply chains and markets. Acute are those that are like heat waves, hurricanes, cyclones, etc., flash droughts, maybe floods. And chronic ones include slow temperature increase, shifts in rainfall patterns, sea level rise, etc. First order impacts includes extreme precipitation, heat stress, water stress, cyclones, rising sea levels, cold snaps and winter storms. Hardly comprehensive, but nonetheless can be measured in physical terms and estimated financial terms. Second order impacts, climate hazards that affect the broader economic, human and natural environment. Transmission pathways from climate hazards to firms may include ecosystem collapse, migration, social license to operate, impacts on human health and so on. Finally, impacts on corporate value chain are difficult to predict and quantify a priori based on acute and chronic climate stresses or impacts. Okay, so that brings to this relatively long section on managing financial and macroeconomic, macro-fiscal issues under adaptation to climate change. Okay, so let's finalize the course or this book at least with the next section, and then there are some examples of applications. Next section is on applications, and then the annex has some important information that I'm going to include as well. Okay, see you.